Are you guys going to be recording this?
Yep, I just started the recording. So welcome, everybody. My name is Andy Goddard, and super excited for this little meeting that we are getting to have today. I want to introduce to you, first of all, I don't know about all of y'all, but I feel like the amount of financial training that I got in my life left me completely unprepared to manage money. So I don't know how many of you are hearing me on that, but my financial training was basically my dad saying that money is the root of all evil, and that people who have money, it's basically a function of chance, and it's those who, it's basically just kind of God's will, whether you have a lot or whether you don't. And we don't have a lot of say in that. So guess how much financial education I got? Like zero. It was a taboo topic. It was money and sex were the two things we never talked about in our home. And so, no complaints. I'm just telling you where I'm coming from, that didn't get any financial training at home. So with that as the setup, let me introduce to you one of our dear friends who we really only met, what was that, 6 months ago now, Easton?
Yeah, in the fall.
So Easton and Rebecca Kelsey are two beautiful souls who have been in this space of financial education and mentoring and coaching others for years. Easton actually, before going into this, was super passionate about policy and politics, and so he actually ran for Congress, right, Easton?
Yep.
So he lived in Arizona, so that's where he ran. The thing I love about Easton is his complete dedication and passion to principle. We just got to spend the week together in Puerto Vallarta, and we had so much fun. But most of our beachside and restaurant conversations were focused around, true principles. And one of the things that I know about Easton is the cause that he is most passionate about is freedom, freedom and liberty. And we're not just talking about financial freedom. We're talking about the whole picture, right? Like how to live a free life. And I don't know what accreditations he has. I'm sure that he's been mentored by some of the best. Many of you have read books by Chris Brady and Orrin Woodward. They've been a couple of our role models, especially in this space. But Easton knows them very well and has been coached by them. So Easton, welcome to the group. This is a really special group to us. This is our Diamonds and Above. And I see we've got people from literally all over the world. András is in Hungary. I thought I saw, Giada. I think she's sometimes in Europe and sometimes in New York. So we've got a really global team. We've got Lou from Mexico. Yep, Giada in Copenhagen. So we've got a really fantastic group with us here today. So with that, Easton, you want to set me straight on anything I said wrong in my introduction?
No, you did fine. No, I'll just put things in perspective for me.
You mind showing us your face and taking off screen sharing just so that we can get to know your gorgeous mug? Easton is also an optometrist. So he has not only the financial training, but he's also Is that right? The right word? Optometry.
Yeah.
So he's got lots of letters after his name and lots of reasons to trust what he has to say.
Well, thank you, Andy, for that generous introduction. It's an honor and a privilege and humbling to be in front of such a wonderful group. But what I've experienced in my life, being an optometrist, having a doctor's income, and being a top 0.1% of another network marketing company, is that it doesn't really matter how much money you make in life. Well, it matters how you make it. So we all know that, or we wouldn't be here. But what you do with it, right? And it really matters. And the truth of the matter is, I'm a great example of what can happen if you make a lot of money and you don't know how to handle that money. So we call that financial illiteracy, and most of us have that. Now, Andy talked about that. Most of us get that, our training, how we were raised, the environment we were in, whether we get the education or not. He must have figured out something because he's doing pretty well in the income part, and he's got 7 kids. So that whole, sex and financial, he figured out something. So anyway, but you're right. Most of us don't know that. We have a particular money view, and so that's how we approach it. And I submit to you, and I think one of the reasons that he wanted me to speak to you is that if you make a lot of money and you don't have financial literacy, you can get yourself into further trouble and stress than you can if you don't make a lot of money. So if you make $50,000 and you save $10,000, but if you make $500,000 and you spend $600,000, you're going to be worse off. So it gives you more rope to hang yourself if you make a lot of money without the financial literacy. So what today's presentation is really talking about is coming from a foundation that you're out of debt. And I know doTERRA is amazing when they promote that to be out of debt. So I, in 2010, I got involved with this group, and my wife and I, we got married. We pulled our poverty. As an optometrist, I had about 80 grand of debt. She had about 40 grand. So we had a lot of debt, and so we were starting off kind of behind the 8 ball when we got involved in network marketing. But I was really fortunate to have this information from a couple of gentlemen who not only are geniuses when it comes to network marketing, but also they knew how to handle their money. And Chris Brady and Warren Woodward live on less than 5% of their income. They're very well off, but they're not ostentatious. They don't show it. And Warren has a yacht, but it's usually just to help other people catch their dream. He's not like a worldly guy. So anyway, the whole point of this is to help you understand that once you're out of debt, and so it took us 22 months applying these principles. We wiped out all that debt. We put about $124,000 in the bank, and went from 6 days of optometry down to 3 days, and the next year down to 2 days. So as outside of actually owning a home, we own our cars. We don't own a home yet. Home ownership's a little tricky because I'm not a big fan of having a mortgage. The word mortgage in French means until death. And so I'm a fan of actually, if you have assets to buy a home, buy it and buy it quick, so you're not supporting the financial matrix. So that's what we call the money control, people who print money. And anyway, won't get too much into that stuff, but I'm a big fan of freedom, financial freedom for sure, and the ideas that go behind that. So we'll go back to this. And by the way, there's a lot of people on here. I'm sure I'm not an expert on all this stuff. Like I said, this is educational. This is not an investment advice. This is an educational overview of building assets over time. Okay. And so if a lot of you guys, there's probably people on here that know more than me in this particular subject. And I know that maybe you could share those gifts in the future with the group too. I think that would be great if we do maybe an ongoing series. And also my perspective is going to come today from America, United States, investments, those types of things, but those around the world. Everything I talk about, there's an equivalent in your country. Okay, so that's the good news. Even though I'm coming from that perspective, in the education, just know that there is an equivalent in wherever you live. Okay, so that's good news. So let's go ahead and get this going. So this is a Beyond Financial Fitness. It's a program that it's after the initial one we have that helped Rebecca and I, what's called Financial Fitness. And so this is based upon, okay, now you're out of debt. What are you doing with your money? You know, what's next? And so, oops. So it's based on that book that they wrote, Beyond Financial Fitness. It's a workbook. It's some audios, some videos. It's just a holistic way of learning this information, how to build security and prosperity for the future. And so this is a significant statement. The wealthy use their money to acquire assets, while the middle class use theirs to buy stuff they want. Okay? And so, and that's a big paradigm shift. So a lot of us, have struggles with that. They're like, okay, well, that's what money's for. It's just to buy stuff we want. And no, it's for build for the future. It's for hopefully everybody on here, and I know doTERRA is an amazing culture. Hopefully you're using your money as a stewardship and to bless other people's lives. I like the Goddards done that tremendously, and we're so grateful for them. But also, for your legacy, to fund your purpose, for paying it forward, for all those different things that you're here to do on this earth. Hopefully you figured that out. They say the most important things is the date you're born and the day you figure out why you're born, right? And so today's the investment policy in general is, number one, pay yourself first. So no matter how much you make, you always want to pay yourself. Now, I personally pay God first. That's my personal belief as far as tithing goes. If you're, I know in especially in the European countries, there's a tax on that, and that's a big. I lived in Germany for 3 years, so I know a little bit about that too. There's no incentive for tithing, but I know God will bless you if you do. So pay yourself first as far as that goes. A minimum of 10% you should be putting away every month of what you're bringing in. And the dollar cost averaging just means that, over time that, you're not too concerned about what's happening in the short term as far as the market goes or the fluctuation, interest rates and all that stuff. And just know that if you do that over time, you're going to come out ahead if you keep paying yourself first. And the number 3 is where we're going to focus today, and that is understanding the risk factors. Okay, so we're going to start with the biggest risk factor of all, and that's us.
Easton?
Yeah.
So I'm going to prove my illiteracy here. What does dollar cost averaging mean?
Dollar cost averaging is that you're just not focused on whether it's a bear market or a bull market. You're not focused on what the Federal Reserve is doing. You're not focused on the short-term fluctuations from year to year, even decade to decade, just knowing that when you put money in consistently, saving it over time, that you're going to come out ahead no matter what happens in the market fluctuation.
Okay, got it.
Okay. So the biggest risk is ourself. And so that's the whole point of this, is to understand financial literacy, because you are your biggest, you can be your biggest asset, but you can also be your biggest liability. Okay, so that's the point of this, is to help you make your money make more money, and to help change your paradigms a little bit about that, and to help kind of build this snowball that gets bigger and bigger over time, and understand you can maybe slice off a little bit for here or there for what you want, but understanding the big picture that the money is a stewardship, and it's hopefully for funding that purpose and a legacy. So let's start off at the very bottom of what we call the risk meter. Andy, did you get that image? That was the only image I wasn't able to insert. There's a risk meter, and we're going to start at the bottom, which is the least risky investments. Okay, and we're going to go up more complex. I'm just going to touch on these. I'm not going to go in any depth on any of them. It's just to give you a flyby overview of the entire range of investments of where you can park your money. I've had some experience in many of these, not every single one of them. So we're going to start at the bottom with the low risk, gold and silver. We're going to go all the way up to top. I promise you, I will try not to let your eyes glaze over. We'll try to move through this quick and make it informative. Awesome. All right. Thank you. And what's that?
Did you want to share mine or yours right now?
Let's go back to mine.
Okay, sorry.
So just kind of give you an idea of where we're going to go on this.
I think you have to start screen sharing again.
Yeah, no worries.
Okay.
So gold is something, it's interesting. There's a lot of people that are it's kind of controversial, like people call gold bugs. But, and honestly, I think there are things that are instruments that may be even better now with technology we could talk about towards the end. But gold is something I have invested in because of the fiat money systems that, Nixon took us off the gold standard in America in 1971, and our dollar has declined 95% since then. Okay, that's how our dollar is declined in value. And similar things have happened to currencies around the world once they were taken off that. Okay, so this is not historical education. It's just to let you know. Gold has been constant over time. They say that an ounce of silver would buy Caesar, he'd buy him a nice tunic. It'd buy George Washington a nice uniform. And today's day would buy us a guy a nice outfit suited from head to toe. The same amount has been constant over time as far as what an ounce of silver or gold is worth in general. It's called flight to safety. We understand that, there is some safety there when it comes to that value. There's only so much gold in the world. It's a store of value, and it's what we call freezing your fruits of your labor. So it's not so much an investment material as a place to park some of your assets. And, most people will tell you, in fact, if you go to a lot of the hedge managers now, some of the big hedge managers, they're talking about gold because they don't have a lot of faith in the market and what the governments are doing with all the fiat money and the money they're printing. A lot of these hedge managers are investing heavily in gold. So whether you do that or not, I think you should have some gold, whether how much you have or not. I'm not a big fan of certificates. I'm a big fan of physical gold, of actually having it. Okay. Then there's also silver. Silver, same thing, is a store of value. It's more likely spendable in a crisis because in smaller denominations, let's say, if you had to spend it, an ounce of gold would probably be an overkill to get a loaf of bread, something like that. It has a lot of industrial uses. It's more volatile than gold in the market. It's used for a lot of different things, and there's a lot bigger supply of that. And I have some of that too. Cash on hand, I'll tell you kind of a story that ties in my gold and silver with this a little bit. A little sad, but you can learn from it. Cash is basically, it's a good idea to have some money on hand that you can get to quickly. Whether you have it in your house or you have it in a safety deposit box depends on you. I particularly had it in a safe that wasn't, quote, safe. It wasn't bolted into the ground. It wasn't, anyway, I had my safe still. I had about 43 grand of gold and cash and silver. And it wasn't safe. I actually got stolen out of my house. So I learned a lesson there. But the big lesson was that I reframed that everything it took to create that was right here in my head. So after 30 minutes, I got over it. But we actually know who did it. But, the law is slow. So we'll see if justice ever comes. No big deal. But just be careful about storing a lot of cash on hand unless you have maybe some, a laser tripwire and some Dobermans and Cobras and stuff. So anyway, just teasing about that a little bit, but maybe a safe deposit box. Understanding that if you do put cash under your mattress, inflation's still going to eat at it. Okay, so there's still an issue there. It's not completely protected, but it's good to have some cash on hand. So now we're going to get into, I'm sure you guys understand some of this stuff. Insured savings accounts. We have the Federal Direct Deposit Incorporation. They insure up to $250,000 per account, and internet banking is an option for that. But savings are little to nothing when it comes to regular savings accounts. It's minuscule, but it's pretty safe. The next thing is what we call certificates of deposit, or CDs. Some of you have heard of this. You get a slightly higher interest rate than a regular savings account. The depositor agrees to forego access to the funds for a period of time. So for instance, I joined Mountain America Credit Union just recently. And if you have a 6 month, if you park your money for 6 months, they'll give you 1.49%. If you park that money for 5 years, they'll give you 3.5%. So it's pretty safe. It's not the best return on investment, but it's pretty safe. And it does protect you against you if you want to put that money away where you can't touch it. So until, if you feel like that's an issue. Most of those are insured by the federal governments too. It's not real popular when interest rates are low. So that's one of the benefits of the rates are starting to go up actually. Money market accounts, MMAs, these are a little bit better, pay a little bit higher rates than savings and sometimes more than the certificates of deposit. Instead of promising your money after a certain period of time, you usually have to meet a minimum balance amount. This is great. It's nice to have that liquid, and it's growing. Depending on what particular thing you put it in, is you can get mutual or stocks as far as that goes, money markets. So they can grow that way. Health savings accounts, HSAs. I'm a big fan of these when it comes to taking control, and we're always obviously health-oriented group here. But if below a certain income limit, you can save toward your medical expenses tax-free. You put your money in pre-tax, and which is great. No tax either way. That's a rare event. Interest and other savings grow tax-free. It's limited. You're limited on the annual contributions on that. Okay, but you can use that for if you get towards the end of the year and you're healthy, because we're a pretty healthy group. You may use it, maybe for LASIK or something like that. Just saying. There are some things you could use it for. Educational savings plans, 529s. These are tax advantage towards college. Depends on which state or country you live in. Like I said, it can change. Earnings are not subject to federal taxes. Also, some states also can no state taxes. Depends on the state. But you have to use it for direct expenses. You can't, it just can't be for gas or whatever. It has to be direct college expenses or parties. Okay. Annuities. This is a type of insurance. Some of you have heard of this. It seems to be a mystery, but a lot of talk and controversy over annuities. It actually started back in the Roman times when they would pay the soldiers salt, and they would put a part of that away for themselves, and then when they retired from the military, they're all broken up, and however long they lived, they would have guaranteed income for the rest of their remaining of their life, however short it was. Result was a guaranteed lifetime income. So a properly structured annuity is the only investment vehicle can guarantee you will not run out of money to the end of your life. There's 3 types. Fixed means that you get a certain percentage over the life of the annuity as far as interest. Indexed means it's tied to a certain investments. So like Standard & Poor's 500, if it grows a certain amount, then yours will grow according to that particular market. And then the hybrid's kind of putting those two together. You have a floor and a ceiling. Don't worry if all this doesn't make sense. It's just some of it's just to have an awareness of these types of things. So like I said, I know it's not that fun, but we'll try to make it a little bit, spice it up a little bit. So once you put your money in, you can't get it back without significant penalties in annuities. If the remainder of your annuity is bequeathed, I love that word, to your beneficiaries, upon your death, they must pay taxes on it. Many poor products and unscrupulous marketers to be aware of in this whole category, and it is complicated. Not my favorite investment. Life insurance, this is probably actually one of my better, what I think is one of the better investments overall of where to park your money. Companies are notoriously safe, and institutions protect each other within a state. If you think about it, they say, well, you know what they say is the oldest profession, but the actual answer is insurance. It's not what you thought when I first said that. So this is actually, it's like a really good place to put your money. Look for a rating of at least an A. There's 2 main types of insurance. There's term and there's permanent. So term is I have a policy where I pay like, a good health. I got it in my 20s. I pay like $45 a month for 20 years. If I pass away in that period of time, it's like $1 million policy. So the healthier you are, the younger you get it, the better the benefit. But it's a term. So once it's done, that premium will go way up. So it's not really that good of a. It's really just insurance for my life. Permanent insurance has a death benefit and cash value. So that's more of that investment vehicle is the permanent insurance. There's 3 types of permanent insurance. There's whole, universal, and indexed universal. Without getting too much in the weeds, I'll just kind of say this. Whole insurance, basically you pay a fixed premium over time. It's pretty much fixed for the life of the policy. Okay, you can't borrow against it and use it, that type of thing. So there's some benefits there. Universal is a little more flexible. The premiums can change. If interest rates are going up, there's an advantage because the interest that you earn on a whole is adjusted usually once a year. On a universal, it's usually adjusted once a month. So if interest rates are going up, you're going to earn more on that policy. So there's it's more flexible, universal. Index just means it's tied once again to, let's say, the stock market or S&P 500. So if that year the S&P goes up 11%, yours will go up. You maybe get 8% or something like it's capped. But the nice thing about indexed insurance is that you never lose your base, which means like no matter if it's a bear market, if the market goes down, you will not lose the money you put in. It won't go down. Okay, that's a pretty amazing investment vehicle right there. So there's a lot of different types of little things you can add on. Like you can add on extended care type policy. So if you get sick or that type of thing, or you're eventually in nursing home or the extended care type things. There's a lot of fun things that you can get or added on to this type of insurance. So that's my favorite is the indexed universal as far as its flexibility. Okay. You could use it tax-free. You can bequeath it. In other words, you give it on to your kids or whoever. Maybe you don't want your kids to have it. Maybe that's a good way to incentive to keep them behaved. You can vote them off the island. It can help pay estate taxes. One reason annuity may not make sense is because of all those things I just mentioned with life insurance. And the cool thing about life insurance is you can open several policies. So you want to park. You can only park so much money in one policy. Wow, what am I going to do with this? Well, you can open up several policies and park your money in different policies. So, Warren Buffett swears by these. If you want to talk, one of the richest guys in the world, he knows what he's talking about. But it can also have provisions, like I said, disability, extended care. So that's cool. Let's go into bonds. These are also known as fixed income securities. The worldwide bond market is huge. To put it in perspective, I think the stock market, there's about $45 trillion invested in. The bond market's about $95 trillion. So it's huge. That's because governments are funding, they're creating them. They can print money, so it's pretty easy to quote when you call it money, and they have the ability to call it money. But a contract to pay back a certain amount of money with interest. Open trading in the public market, so that changes the bond's price, which changes the yield. In other words, what you actually earn from that. The interest rate's fixed, but the prices fluctuate. So that can change. That's the thing that kind of makes bonds something you have to be careful about when you buy them. Is what's the value of that bond historically? But it is one of the safer investments. There's 4 different types. Like I said, I'm talking about it in the United States, but I'm sure that in Hungary they have something similar, I hope. U.S. savings, treasury bills, treasury notes, treasury bonds. When you hear the word, you might hear T-bills, T-notes, or T-bonds. That's what they're talking about. Generally, the longer the terms, the higher interest it pays. Pretty much makes sense. Interest on the federal bonds are not taxable at state or local level. Very liquid. In other words, you can get rid of them really quick. If you need to, get the money. If you need cash in hand, most advisors recommend having a portion in your portfolio. So if you're actually working with somebody, and they're going to probably recommend a portion of your investments go into bonds because they are relatively safe. Sovereign just means other governments. You can actually invest in other governments if you want to. Mature would be like a France company. Emerging might be, I don't know, that might be, let's say, Indonesia or something, and frontier might be Somalia. Might be something that's really just coming out into their market. So anyway, the higher you can have a higher yield on those bonds, but obviously there's more risk in those types of developing countries. All right, let's talk about stocks or equities. Basically, you have a small slice of ownership in a company, and there's what we call growth versus income strategy. That just means that you put money in, and hopefully the company grows, so your stock grows. Okay, but also the company, as it grows, it also can pay dividends to its shareholders, and so they basically can feed off money to you. You hold on to the stock while it grows in value, and they're also paying you a dividend off of that growth from year to year. So that's nice. But still risky. I'm not a big fan of stock market just because I'm not a big fan of the governments. So anyway, that's my own personal feeling. Capital gains, paper versus realized gains. And plus, I lost a lot of money in the stock market because of the downturn in 2008, 2010. So it's probably one of the reasons I'm sour. Capital gains, paper versus realized gains. That means that if you earn money on your stock on paper, you don't pay any taxes on that at all. Any on the gains that you got on that stock, you only would pay it if you sold the stock. That's what we call a realized gain. When you sold it, you got the money. So Warren Buffett, that's what his strategy is on that too. Is the understanding that you can grow that and not have to pay taxes. Capital gains tax is usually lower than dividend rate tax. That means that if you make money on a stock and you sell it, the tax rate is lower than it would be on the dividend that they pay out over time. So it is lower than typically tax rates. So that is one of the advantages of that. Market capitalizations, if you buy stocks, you might see these different terms of different size of companies as far as how much stock is in that company. So what we call a micro company has less than 250 million. Then you see the small, mid, large, and then ultra. You can see the numbers there. Ultra is greater than 50 billion. That's a pretty large, lot of stock in that company. Stock exchanges and brokerages, basically where you buy your stock, you can go directly. Now you can go online and do it, exchanges, but you can also hire a broker, or you can have a broker house like Vanguard or something like that. There's a lot of these different places. EF Hutton, I could go on and on and on, right? Where they're actually brokerage firms, but a lot of times you just go in and self-directed. If you understand a little bit, you can buy the stock and sell it if you want. But if you haven't put your 10,000 hours in this, be careful. You might want to have somebody who knows what they're doing, or you just want to play around with some funny money, then go ahead and do that too. Fundamental versus technical analysis when you evaluate a stock. That just means that there's different strategies. You can look at the different aspects of a company and say, well, they look like they're healthy. That's a good thing to invest in. Or technical, you're just doing straight by numbers. If you look like, anyway, there's different ways, and there's people that actually kind of use both of those things too, as far as finding out what stocks. You may just know somebody who's put their 10,000 hours in, and then you ask them, hey, what's good stocks to buy in? What would you suggest? What are you buying? Long versus short sell, without getting too much into that, it's just long sell just means that you are basically betting that the stock market, that stock's going to go up, and then that's a long. And then a short sell is that you're betting that stock's going to go down over time. So different strategies for that. Real estate. This is another one where you either buy a property and then every time you sell that property, you have capital gains, whatever. You can do that every couple of years, I think. Most countries, you can do that. Or you're buying rental properties and you're getting some ongoing income from that. So there's different ways, and there's also commercial versus residential, people living here, or a business type thing. Very illiquid, so that's one thing. If you put your money in real estate, don't plan on getting it out quick. Lots of taxes, fees, and ongoing costs when it comes to this. There's 3 types of taxes: property income tax on rents received and capital gains. So basically, so if you own your home, you don't really own it, because if you don't pay your property taxes, they could take your home away, even if you, quote, own your home. So property taxes are something that are just part of home ownership. Income tax, basically, if you have rents coming in, you got to pay tax on that. If have rentals. Capital gains, if you sell it, obviously you have to pay taxes on that. And once again, that's lower than the regular tax rate, so there's an advantage. Be careful with real estate. This is something where I've seen guys that they have their 10,000 hours, but they're getting people involved, and those people don't have their 10,000 hours, and so they're kind of making money off of those other people, OPM. So just be careful that you're not an OPMer. That you're not, that they're not just making money off of you. But it's the sad thing about this is it's one of the easiest things to borrow money for in order to buy. So the governments love to give this money. They love to get us into debt. And like I said, I'm not a big fan of debt. So tax deduction for interest paid on those loans. That's why people justify mortgages. But like I said, I'm not a big fan. I like to own things as much as possible. This is where you get a real estate investment trust. Basically, you get those people that have that experience in real estate investing, and you trusting them basically to make smart investments, and they have to pay out 90% of their income to their, quote, shareholders or partners. It's really easy to purchase. You can do stuff like that online, like even these brokerages. That is very liquid when you do this type of thing. So this may be an easier way to invest in real estate. Anyway, I'm not big. I haven't done it myself, but I know people who have. But just be careful who you're getting in business with. That's all I'd say on that one. None of the hassles of actual property ownership. That's kind of nice. They can offer wide diversification or specialization. That means let's say that you want to invest just in restaurant industry in Florida, or the travel tourism in Hungary, or whatever. You could kind of pick different aspects that you want to actually specialize or invest in. Dividends, taxes as ordinary income, so something to kind of consider on that. But maybe best inside like a 401k or smaller. I'm not a big fan of 401ks. When mine turned into a 201 and then a 101k, plus the governments have been threatening to kind of confiscate those for years anyway. So not a big fan of 401ks personally. Risk. So we've gotten through a lot of this already. Hopefully it wouldn't bore you to tears. I'm going to go over some of this. These are kind of the high risk category, the highest, that little thing that Andy showed you, that the little thermometer of risk meter. These are the highest risk. I'm not going to go into these too deeply, but just be careful. In general, if you haven't put your time into these, you just know that I wouldn't put any money into any of these that you can't afford to lose. That's the bottom line when it comes to any of these I'm going to talk about. Commodities are, like let's say pork or oil or soybeans. Basically, you can buy commodities on exchanges or brokerages. Futures, basically, that you're betting on the future price of a commodity. That's what futures are. If you heard that word and you're like, what the heck does that mean? You're betting that that commodity is going to go up or down, whether that's, like I said, oil or whatever it is. Not our oils. I'm betting our oils are going up. So anyway, I could bet on that future. Derivatives, that's an investment vehicle where you're deriving value off of something else. Okay, that's the simplest way to put it. Currencies currencies, there's some people I know that just all they do is day trade currencies, and they make money depending on the rate of the currencies and how they fluctuate and change. Once again, if you don't, you got to know what you're doing. You're going to make some expensive mistakes learning a lot of these things. So may want to, if you want to get involved in any of these things, maybe do it on a small level. Do it with somebody you trust who has that experience, that a good experience, like with good results, so they've learned their lessons type thing. So venture capital, that just basically means that you have a somewhat established company and they want to grow, and so they're looking to bring in investors and to give you a share of ownership of the company. Most of you guys maybe have seen Shark Tank. If you haven't, it's very educational, but that's pretty much what that is, venture capital. Kind of fun, kind of cutthroat, kind of risky. So angel seed funding would be your brother-in-law comes to you, they have an idea of something that needs to come to the market, or it's a really just early company just barely getting going, and they just need some seed funding to get it going and get the structures in place. So like I said, pretty risky stuff. If you do something like that, just maybe out of the goodness of your heart, don't expect to see it come back to you. Art, another thing too, very subjective. Jewelry, gems, collectibles. And then the last thing I put here, talk about here for a minute, is I put current cryptocurrency. So maybe you know what cryptocurrency is, maybe you don't, but it's basically, it's private fiat money. It's digitized money that basically we say, yes, this is money. It's all digitized. It's kind of a weird concept. But currently right now, as it stands, cryptocurrencies are very, very speculative. So because right now they're not being used actually in commerce on a regular basis. It hasn't been adopted by the masses, and until it does, I don't see this. I see this as purely as speculative. And some of you guys know a lot of people maybe made some money, maybe lost a lot of money. There's still a lot of fluctuation when it comes to cryptocurrencies, Bitcoin, and that type of thing. So be careful if you're going to do that. If you're going to invest in that, just make sure you're okay with losing it. So because I know a lot of people that got up, they've gone down. Any type of thing where it feels like gambling, it probably is. So if that's the sad thing about gambling is you can win a little bit, you get the psychological, ooh, this is exciting, and then you want to put more money in. It's kind of like double it down, double down, and eventually, boom, you lost it all. So just be careful with those types of things. I hope this has been helpful for you. I kind of ran through it quick. So I kind of want to open it up to the group here. If you have any real specific questions, I may or may not answer you. I may defer. And plus, like I said, I'm sure you've got a huge brain trust here, a huge mastermind. There might be some people here in the group that want to speak to one thing or another that I talked about, touched on, as far as their experiences, either good or bad. So I'll just kind of turn it back to you, Andy, if you want to moderate or whatever. I'd be glad to answer any questions.
Well, thank you so much, Easton. That was, I don't know about everybody else, but that was super helpful for me. And that's exactly what I was hoping for, was just a really high level overview of, I've created a really great income with doTERRA. Now what? Right? Like what do smart people do with their money? Because there's a million things. I mean, I only probably get approached 5 times a day with different exciting investment opportunities. So this has been really useful for me. And I'm just going to go back really quick to sharing that chart that you sent over. This is the high level overview of everything that Easton's covered today, from highest risk down to lowest risk. And so just really, really useful for me to be able to see this at a glance and now, okay, what's my risk tolerance? What am I willing to do? With this chunk of money, am I willing to go high or low risk? And have I got my bases covered? Have I done some of the basic things first? before I go out, and maybe I do want to take some risk, but do I have some investment into low risk stuff first? So maybe I could lead out with one question, Easton. I've been told that the number one cause of bankruptcy in America is inadequate health insurance. So people, they either didn't have a policy in place, or they thought they had the right kind and they didn't. Was that somebody just trying to sell me some health insurance, or is that truth?
That probably is true when you look at the masses, because you think about most people are living paycheck to paycheck and they don't have assets, and so yeah, if you look at the overall population, there's a kind of a socioeconomic tie too to the folks that maybe aren't making a higher income, and their health, right, or socioeconomic status. There's probably some connection there with that. Unfortunately, like, it's this kind of donut hole that the wealthy take care of themselves. They all, you have to have a catastrophic type of insurance plan for sure. I mean, that would just silly not having sort of something catastrophic, because we don't know what could happen to us. I mean, I've had some not personal, but my daughter Lindsay, when she was diagnosed with Hodgkin's lymphoma a few years ago, and if I didn't have insurance, that would have been an issue. It would have been an issue for sure, not to be properly insured. So yeah, it's a big issue, because most people, they just rely, they kind of feel like it's the society's obligation maybe to take care of them when they fall.
Right.
And, and here we are in the United States anyway, with, what are we at now? Like $22 trillion of debt because of that attitude.
Right. It's not.
So someone's going bankrupt, whether it's the government or the individual. Someone's going bankrupt because of that attitude.
Yeah. Well, I can tell you that when our son Max had his burn accident, I had kind of grumbled about paying health insurance my whole life. But when his total bill came to $800,000 to treat his burn, I can tell you that having health insurance was the best investment I'd ever made. So just, if we were to give any coaching, I think to cover your bases first by making sure you have adequate health insurance.
Yeah, that's true. It's not, I guess it didn't cover it because it's not really considered, it is an investment in your health. It's an investment in yourself. But yeah, health savings account within that is a good way to go as far as your money goes. And obviously getting involved when you can, in your company or your region, as far as Prime Meridians go, we'll have an opportunity. And I think hopefully there are more of these concierge type plans, right, too, where we can just have a subscription every month where that covers the basis for that if we need care. But we're taking care of this group. Hopefully it's skewed with how well we're kind of taking accountability for our care. Yeah. But we have to plan for the future too, right? One day we're going to probably break down somewhere along the way, whether there's an accident or decrepitude or whatever. I'm on 119. I'm finally probably going to break down. So probably going to need some long-term health care, hopefully, or maybe I'll pull a Bilbo and I'll just disappear overnight. I don't know.
I love it.
They'll have to take care of you. Go hide in a crevice of a rock or something.
Well, let's open it up to questions. If you've got a question, just go ahead and unmute yourself, and let's make this Q&A for those who want to.
I got a quick thing. This is Ben Scoville. Hey, sorry, I'm in the dark here, but
hopefully not literally, just figuratively, not figuratively, right?
And hopefully not financially, right? No, one thing that I've heard that kind of resonates with me that I need to work on more, I think, is the savings part. Like, you could have you can get a quick raise by cutting down on expenses. That's what I've read. But I need help with that. Do you have any tips on that? And
Well,
also,
I will tell you this. This is tricky, okay, because and it's a little sensitive, but there is a book called I think The Millionaire Next Door, and it says the number one impediment to building assets is a spouse who's not on board.
okay.
Okay, so and I will have to tell you by sad experience, that was my first marriage. Okay, so I'm here to tell you from some of the lessons I had. That was one of the bigger issues in that first marriage, was we were not on the same page financially. And I would be really good about the small things, and we would set a budget. You know what? Budgets don't help if you don't follow it. So and it's really frustrating, right, when you can't get your spouse on board. And it really can create a lot of stress too. Yeah, I think part of it is just kind of understanding the money view, understanding that long term, getting that both parties on board as far as that goes. And you're right, like that is a huge way to give yourself a raise. And the first way to do that is you have to track. Like, you have to find out, just like if you're going to lose weight, you have to find out what is going out, right? They say that if your outgo exceeds your income, then the upkeep will be your downfall. So hopefully that didn't directionally confuse you, but you're right. So and that's because there's a subjective difference between what's an expense and what's an investment, and that has to be agreed upon. In general, I think an investment is something that's going to bring back some sort of benefit or some sort of whether that is your health or so that can be subjective. And so that's the thing you have to kind of get on board with, is what is an expense, and then track those expenses. There are different ways you can track expenses. There's some programs you can do that to find out what's going out. And then when you can make those agreements, not expectations, but agreements on those things, and because really everything that we're talking about, we have information first. We have to get the right information, and then the right thinking, the right paradigm, the right perspective, and then we have to develop actions and behaviors and habits, because we're ruled by habits. And the good news is we get to pick those habits. And probably the biggest, like you said, Ben, especially with people who are making a good income, is just being indiscriminate when it comes to expenses. So thank you for bringing that up, and hopefully I didn't step on anybody's toes.
No, that was perfect. That was great. What other questions do we have for Easton while we've got him?
I have one more if nobody is jumping in
Go
here.
for it, Ben.
I've heard top producers in network marketing companies talk about investing in hard assets, that they don't like getting into risky things like stock market and different things like that. You talked about the safe to risky scale there, but what are your top hard asset type of things of investments, and do you recommend that same line of thinking?
Well, when you say hard asset, you're talking about like are you talking about real estate and
real estate? Yeah, probably gold and silver.
So for me, I'm a big fan of gold and silver. I obviously, because of where they're placed on the risk chart, but also like I said, I think there's going to come a day where where we actually have a safe cryptocurrency where that actually may be as good as gold and silver. But for now, I think it's still a good idea to have some gold and silver hard assets as far as that goes. As far as, parking your money into real estate, I think it's a good idea if you can do it over a relatively quick period of time. So if you can, so Rebecca and I want to build our dream home here down in St. George area. And we buy a plot of land. We want to be able to have that land and pay for it, have it actually own it, and then build a house, have that house built and paid off within 3 to 5 years. So we're not talking about like I said, a 30-year mortgage that in our society, because of especially those that have jobs, You're kind of locked into, I got to move here. I'm forced to move here, this job. So it's hard sometimes. We basically refinance or we refi or rebuy every 3 to 5 years when it comes to real estate, and we never really get ahead, most of us. So like I said, I'm really careful about real estate, but I think it's a good asset as long as you can purchase it over a way short, cut that, even if it's a 15-year mortgage and you make an extra payment every quarter, every year, and then get that down to 7 or 8 years, I think that's still a pretty good hard asset investment, Ben.
Great, thank you.
Awesome, great question. All right, who else has got some questions for Easton?
Try to wrap it up in a few minutes to be respectful, but I'll be here for at least 3 or whatever. I'll be here as long as you guys want.
So Mark Garrett put a question in the chat box. Did the risk chart include investing in your business? No. So that's a good question. Now, beyond the financial fitness course that precedes this, it has a pyramid of what we call investment pyramid, and that basically the very first investment should be in yourself. Okay, so that includes your business asset. Okay, so that's this. We're talking about beyond that, but you're exactly right. The number one investment is in you. So in your health, in your family, you have to be incorporated. You are your number one asset. Number one. Okay, your number one liability, your number one asset. And part of that is, yes, you cannot starve the goose that lays the golden eggs, right? If you've got to have that seed weed. So absolutely, number one thing is investing in your brain, in your mind, and in your business, because that's what's going to bring the assets to begin to have the money to actually put in all these other investments. So that's a really good point. I'm kind of coming above that, assuming that most of you guys are beyond that point, but you're exactly right. Great. Love that. Love that. One other point on that. We have probably 5 or 6 worksheets custom tailored to doTERRA, and how specifically to invest in your doTERRA business that are in the Empowered Success System. And so I'm typing up that list right now. So you can go to sharesuccess.com/bonus. I'll put that in the link too, in the comment that I'm going to post. But basically, Natalie and I have blown money every way you can think of in our doTERRA business, and so I like to brag that we've failed more than anyone else, and so we've learned a few things. So in that process, there's obviously incentives, there's bridge plans, there's recognition, all these things, events, personal development, all of those things are ways that you can invest in your business. One of the worksheets, there's actually a chart where you've got your key leaders and then their key leaders, and there's a space with some tips on the side of kind of a brainstorm for how you can invest in your team and get the most bang for your buck. So I'll keep working on that while we take any other last questions. And if anybody needs to jump off, obviously feel free to go take care of whatever you need to. But hey, Easton, do you have another minute or two? We'll have more
so just the last thing I'll say here is that your business is the best investment because you have the most control over that investment. Okay, so that's what's awesome about doTERRA is that it's all in our hands, right? I mean, certainly you can't control your downline, your customers, what they do. But as you provide value to them, that you're investing in them, right? You're investing in your team. You're investing into prospects. Natalie and Andy certainly, I think, are great examples of investing into their teams, into the education, the time, the love, the everything that they do. I mean, on every level, I think they play a high standard as far as investing and giving back and paying it forward. So anyway, just grateful to have their mentorship, their friendship, this opportunity. If you guys want more information on beyond financial fitness, we can get that to you. If you're interested in going through that program in detail, we can give you certainly get you connected with that or any other financial education products.
So Easton, if you were to, sorry, was somebody going to ask a question there?
Oh, I just wanted to throw in one more question.
Sure.
I just wanted to ask, we talked about the safe assets, the safe investments, but what are your top 2 investments for actually growing your money?
I would say, top 2.
Besides investing in your business.
Yeah, I was going to say you and your business are number 1. Number 2, I would say, would be the indexed universal life insurance, because there's so much you're protecting your base, and you have so much flexibility there as far as what you could do with those assets and funds. If you look at the wealthy, that's where they park their money, and those types of vehicles.
Thank you.
Awesome. Any other questions for Easton before we wrap? Let's see. I just pasted the link in the chat box. So again, it's sharesuccess.com/bonus. The first one is actually in the multiply guide, so it's not on this page, but if you just download or buy the multiply guide from doTERRA, there's a page called Grow Your Wealth. Then in the influence guide, there are 2 pages, the downloads that are on this page, the financial freedom planner, and then Invest for Success. And then in the Inspire guide, there's a download called Transfer Wealth. So just, I still remember at Leadership when Corey Lindley, a couple years ago, spoke about investing, and that was, he gave exactly the same coaching that you just gave, Easton. He said, invest in where you made your money. So if obviously we're in doTERRA. If you're on this call, you're a diamond or above. So that's the most sound advice I can give you. Like, because you made your money in doTERRA, like, don't go out there and start playing the stock market, right? 90% of all investors lose 90% of their investments 90% of the time in the stock market. So don't be one of those, right? Like, with Natalie and I always look at how can we grow our team and invest there first before we look at anything else. So Terry, in case that didn't come through, let me just list those again. The web address is sharesuccess.com/bonus. The multiply guide has a page in it called Grow Your Wealth. And then at this page in the influence guide, there's Financial Freedom Planner and Invest for Success. And then in the Inspire guide, there's one called Transfer Wealth. So if you're on this, that message should have gone out to everyone. Any last questions before we wrap? Awesome. Well, Easton, thank you so much for being with us today. Thank you for investing everything you have into your training and your education and your experience. It's a journey to figure out how to manage this stewardship that we've been given, right? And Natalie and I truly feel like we're just stewards, right? Like, anything that comes into your stewardship or ownership, it's not ours. We get to take care of it. And we, for this short time here on earth, we get to be the ones who try to add value and shepherd that. But that's probably been our biggest learning is that when you learn how to unattach from the things of this world, it's amazing how the flow just increases. The less clingy you become, and the less you try to hold on to things, the more it just flows through us. And so that's all money is at the end of the day. It's just energy that's flowing through us. And it's, in fact, there's a great book that is by Marianne Williamson. It's the Law of Divine Compensation. And I could read that book 100 times and still get something new every time. But I'd love to hear from you, Easton, if people were looking for, first of all, this program that you just reiterated, how do they get a hold of that? And are there other books or resources that you would say, start here, Millionaire Next Door? What are some of the top resources you'd recommend?
Well, probably the very first book that I got where I started to even think about this was a book called The Richest Man in Babylon. And that's a pretty basic book. I think a lot of people in network marketing kind of get exposed to that. And the whole idea in network marketing was they wanted you to be smart with your money so you could park it with them.
Yeah.
You can make sure you have your subscriptions and all that and go to their meetings and stuff. So, there's a little bit of an ulterior motive to help you be financially smart, but so you can buy their books and stuff. But yeah, Richest Man in Babylon was a great book. But the financial fitness program itself, I think for us, like I said, for my wife and I, we got to go through those different money paradigms, our money mindsets, and find out where we were, and then understand, okay, we need to shift our mindset, we need to shift our paradigm, because that's the way we were seeing everything. So if we come through these broken down paradigms that we came from our parents, or from a scarcity mindset, or from money funds just my fun or whatever, or just whatever, what I mean, like those types of things you have to get. So if beyond financial fitness, if you feel like you are out of debt, if except for maybe a home, I think if you're still in a pretty good situation, you could go through that. But that gave me a good financial foundation was a financial fitness program. You could probably get it on eBay now, but I'm sure we could find out other ways of getting it to you if you can't find it on your own online. So
maybe I can have
those are the major resources. Oh, and the Book of Proverbs. If you are Christian oriented, if you go through the Book of Proverbs, because everything is, like I said, principles are principles, right? They never change. They apply anywhere and everywhere in the world, always and no matter what. So if you're Christian oriented, go to the Book of Proverbs, and that's chock full of financial wisdom.
I love it. Well, thank you again so much for taking your time and supporting us this way. I know this is a spot where a lot of us get stuck, and you've given us tons and tons of value. So thank you so much, Easton. And thank you everyone for joining us today. I'll be posting this recording in the Diamond Group. So watch for that here in the next couple hours. Thanks.
All right. Thanks for the opportunity, Andy.
All right. Take care.
Love you guys. Bye-bye.
Take care.